Hey traders, and welcome back to the ComLucro channel. Flip patterns are one of the most underrated setups in smart money concepts, yet they deliver some of the highest win rates among all SMC models. When combined with higher time frame context, they become even more powerful than standard change of character setups. By understanding flips properly, you can spot major reversals and trend shifts before they unfold. Today, I'm going to show you a complete trading model built around flip zones, how they form, how to identify them, and how to turn them into clean A+ opportunities step by step. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let us begin. This high-probability setup combines higher time-frame flip patterns with optimized entry tools, such as breaker blocks or mitigation blocks, forming a precise trading model capable of producing A+ trades on any chart and pair. In a bullish scenario, the pattern appears when price flips the latest demand area, right after tapping into a higher time-frame area of interest. Price then returns to the newly created flip zone, which now operates as a supply area. From there, it often reverses with strength, pushing against the current trend and signaling a potential change in direction. In a bearish scenario, the same setup forms when price flips the most recent supply zone immediately after being rejected from a higher time frame area of interest. Price then retraces back into the flip zone, indicating a possible shift from bullish momentum to growing bearish pressure. It is not as simple as it seems. Several conditions must be satisfied before the setup becomes valid. So, let us make everything clear with a chart example. In a bullish market profile, imagine price moving from a higher time frame demand. That means demand zones remain in control. The first step is to identify market direction by marking the break of structure and the demand zones linked to each impulse leg. Every time price breaks a previous high, it creates an unmitigated demand zone at the origin of that move. After marking market structure manually and identifying each break of structure, you can clearly see that the price is in an uptrend. It has already formed several upside breaks, and those moves have created the demand zones tied to each impulse. What we want to see next is price tapping into a higher time frame point of interest, such as an unmitigated supply zone or an unfilled fair value gap, and showing rejection. Once that rejection occurs, price shifts direction and pulls back until it reaches the most recent demand zone on the current time frame. It then tests that area, reacts slightly to the upside, and immediately breaks through it with a strong bearish displacement move. This confirms that supply is taking back control of the market and signals an upcoming shift in direction. Now we have a flip zone positioned in the premium area, which gives us a clean selling opportunity if price retraces into it. This might seem a bit complex at first, but do not rush the process. Stay calm. We are going to break everything down into clear, actionable steps with all the criteria and rules required before this setup becomes valid. But before going deeper into the details, let us quickly revisit what flip zones are and how to identify them correctly. A flip is a small reaction to a key demand or supply zone, followed by an immediate breakout. It's a strong reversal pattern that signals a coming shift in market sentiment and direction. Flip entries are one of the most effective ways to catch a setup early while the market accelerates aggressively in either direction. In a bearish example, the psychology is straightforward. Price is in an uptrend, demand zones are in control, and we naturally expect higher prices. But suddenly, the narrative changes. The latest demand zone fails to generate enough bullish strength to break new highs. It weakens, loses influence, and eventually gets violated. This shows that supply is back in control, and from this point forward, we should shift our focus to selling opportunities. The last up-close candle, or the cluster of up-close candles at the origin of the bearish flip move, becomes the flip zone. In simple terms, Those bullish candles inside the reaction phase mark a key area where we should look for short opportunities if price pulls back. In the same way, a bullish flip zone forms when price shows a small reaction to the latest supply and then breaks above it. In that scenario, the last down close candle or the group of down close candles at the origin of the bullish flip leg becomes the flip zone. Now you might wonder what the difference is between a change of character and a flip. Flips and CHoCH patterns are both reversal signals, but here's the key point. Every flip is a CHoCH, but not every CHoCH is a flip. Price tends to reverse much faster when a flip forms, which means flips offer a stronger edge than standard change of character structures. They are also more mechanical and rule-based, giving you a clear entry point while indicating a potential shift in market direction. But keep in mind that not every flip is valid or tradable. For a flip to be valid, price must first mitigate and reject a higher time frame key zone. This rejection shifts sentiment and prepares the market for a true directional flip. If price does not mitigate a supply or demand zone and instead forms a flip pattern in the middle of nowhere, it is likely an inducement, a liquidity grab, or just a normal retracement, not a genuine shift in direction. Patterns like that should not be treated as valid flips. Flip patterns also become more reliable when price leaves a noticeable inefficiency during the flip, because price is far more likely to return and mitigate the flip zone. To use this model correctly, you need 3 time frames. A higher time frame to identify unmitigated areas of interest, such as supply or demand zones. A main time frame to analyze overall conditions and spot flip patterns and flip zones. And an entry time frame to zoom in and look for reversals and confirmation signals. This is where your entry will be placed. These are my recommended combinations that you can apply. You can use different time frames if you prefer, but make sure to backtest them carefully before using them in live trading. Now, let us go step by step and see exactly how this plays out on the chart. In a bullish scenario, the first step is to analyze market structure on the higher time frame and identify the nearest unmitigated demand area that price is likely to reach. Once price taps into that higher time frame area of interest and shows rejection, the setup begins. Next, zoom into the main time frame and wait for price to retrace upward to test the most recent supply area on the main time frame. After a small reaction to the downside, price should immediately break above it. In other words, flip the latest supply. From there, trace back to the origin of the bullish expansion move, the reaction phase that initiated the break. That origin point becomes the flip zone. This flip tells us that the temporary bearish retracement is ending and that bullish momentum is returning. At this stage, we expect price to realign with the higher time frame trend. The next step is to highlight the flip zone on the main time frame, then wait for price to return to that zone. Once price taps back into the flip zone, zoom into a lower time frame and closely monitor for reversal signals, such as VSR patterns or a clear market structure shift. At this point, we have 2 different entry approaches for opening a long position. Each has its own strengths, the mitigation block and the breaker block. Now that we have covered all the rules, details, and everything you need to apply this strategy correctly, let us walk through a real chart example to reinforce what we've learned so far. Here, we have a 4-hour chart on the screen. As you can see, price is in a strong downtrend and the bears are clearly in control. The most recent bearish BOS is located right here, and at the origin of the move that created this BOS, we can see an unmitigated supply zone. So I am going to highlight this up-close candle as my supply area. This gives us a fresh, clean supply zone. And this is exactly where we want to focus because it is an ideal area to look for short opportunities if price pulls back into it. The next step is to switch into our main time frame, which in this case is the 15-minute chart, to get a clearer view of the price action and wait for price to tap into this 4-hour unmitigated supply. Now let us unfold the chart and see what happens next. On the 15-minute chart, you can see that after tapping into the higher time frame supply, price reversed and formed a clear VSR, a classic V-shaped recovery pattern. If you mark out the bullish BOS levels, you will notice that price created several consecutive demand zones on its way into the 4-hour supply area. Also, after tapping the higher time frame supply, price retraced downward and after a small reaction, flipped the most recent demand by breaking and closing below it. At this point, price is expected to realign with the higher time frame direction, which is bearish. So now we have a valid flip zone on the 15-minute chart represented by this up-close candle. With these confirmations in place, we can expect price to return to the flip zone before continuing its move toward the sell-side liquidity. Next, we wait for price to return to the flip zone, then zoom into our entry time frame, the 1-minute chart, so we can identify a precise entry for a short position. On the 1-minute chart, you can see the price pushed upward and, after tapping the flip zone, reversed sharply and formed both a market structure shift and a VSR. At the same time, it created a breaker block represented by these 3 down-close candles. Notice the sequence here. Price first formed a swing high, then a swing low, followed by a higher high. But immediately after, it reversed direction and closed below those down-close candles. This confirms the breaker block and gives us another strong confluence for a short entry. With these confirmations in place, we can expect price to pull back to the breaker block before continuing downward toward sell-side liquidity. Next, I'm placing my entry at the lowest point of the breaker block with my stop loss just a couple of pips above the higher high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now let us see if the trade plays out successfully. As you can see, price pushed higher, activated the sell limit order, then reversed and dropped until it eventually reached the take profit. This completes the full sequence of confirmations and shows how the flip zone, the breaker block, and the lower time frame shift work together to create a clean, high probability setup. Before we wrap up, it is important to highlight one key idea that connects all 5 ICT strategies we covered. Every one of these setups is built on the same foundation: liquidity. Understanding how price seeks and uses liquidity is what allows you to read market intention with clarity, structure, and confidence. Without this foundation, even the most advanced model becomes difficult to apply with consistency. To make this concept even clearer, we're going to show a short clip from our complete lesson on liquidity. In this clip, you'll see the difference between internal and external liquidity and how price constantly cycles between these 2 areas. The full video explores the entire framework in depth, but this moment alone will help you understand why liquidity is the engine behind every smart money movement. Let's take a look. Liquidity can be classified into 2 types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. If this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper, with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.